Hi, Ellie. Good to have you back on the show today.
And you, Andy, thanks for having me back.
Funny old period we found ourselves in. Again, I feel like we're back in a bit of a bumpy period. The next few months look a little bit uncertain. And I know that you and I have got some of our own thoughts on things at the minute. There's a few things that I would love to discuss with you today. There's a lot of chatter in the community. I've been posting stuff myself.
Yeah.
A lot of it to do with the general direction of travel at the minute, I would say, from a political perspective, but more specifically for us, and go what this means perhaps for rates, for lending, for values, for property investing, more full stop, so to speak. I mean, I just wondered if we could kick off today, Ellie, with borrowing costs, because a lot of people are looking at the market right now and are quite confused.
I get it.
But the base rate has been cut, it's steadily being cut. It looks like it will probably continue to be cut, but that's not washing through to the consumer rates right now. Tell us what's happening.
So I think we sort of split things in two. So you've got kind of residential and less specialist buy-to-let, the TMWs and, those sorts of lenders. And they generally work off the base rate. It's more sort of traditional lending. And their rates generally have come down on the whole. There has been a big reduction, but they have started to come up again. And then you've got the more specialist side of things, which I'll come on to in a second. So yes, we do rely on the base rate, but I think the base rate is only one part of a much bigger picture when lenders are choosing what their rates are. And increasingly, lenders are using wholesale markets to borrow money, and wholesale markets use swap rates. So swap rates are the amount of interest that you need to pay when you're borrowing against other wholesale funding lines, basically. And it's not a now rate like the base rate is. The base rate is the current rate. The swap rate is a prediction of the future rates. And I think because of all the uncertainty, and I'll sort of go on to that in a second about what that is, but because there's so much uncertainty in the world, not just in the UK, those swap rates have gone up. And that's why interest rates, across residential and sort of high street lenders, are going up, which is frustrating because I think everyone thinks base rates coming down. This is brilliant news. And hopefully rates are coming down, but actually they're not. Inflation is still sticking, and I think that's causing some uncertainty. There's a couple of other things going on as well. We've got gilt prices that are they're up. There's a number I was reading last night about all the reasons why they're up, and I think some of these are beyond my GCSE economics. But I think there are lots of things that have gone into the mix as to why those gilt prices have gone up. Some of it is uncertainty around the government lending and the amount that we've borrowed. But there are some bigger picture things in terms of pension funds, which is a global issue. And that's causing it to go up as well.
Tariffs, there's still a bit of uncertainty there.
Yes.
There's just more going on outside, non-domestically that is having an impact, isn't it? That's probably washing through to inflation.
Absolutely.
But
yeah, markets don't like uncertainty. And unfortunately, Trump and his tariffs are literally the definition of uncertainty, aren't they? He says he's going to do something. He may follow it through. He may not. He changes his mind. So whilst you've got all of that uncertainty around it, the swap rates have got to work off a worst case scenario because that's what they're lending on. So it will always be quite a lot higher. Having said all of that, though, the likes of your Shawbrooks and in that world, the rates are far more stable. We haven't seen any change. And actually, the conversation I had with my contact at Shawbrook last week was that they are looking to reduce their rates across the board. So it's a very different market in that world. So if you are looking at investment values on HMOs and commercial, semi-commercial, blocks of flats, all those kind of more specialist products, there isn't any change. Actually, Castle Trust have reduced their rates for existing clients on some products. They're in the kind of low, sort of medium to high fives now, which is a really competitive rate. So yeah, it's a real mixed bag.
It's interesting because, like you say, it is a mixed bag. There is a degree of uncertainty. I mean, the other big one that we'll certainly touch on today is the autumn budget now, which we're starting to see and hear an awful lot about. But as an investor, as someone in the property space, knowing what information to pay attention to and what to disregard, it is quite difficult. I mean, along the same vein, let's talk about valuations then. There's been a lot of chatter about this in the community, I would say, often off the back of some of the more politically charged conversations that we've seen and have been having recently, which I've been, certainly involved in many cases, like, sort of brought to the table. But, I think there are some important issues at the minute. But I think more importantly is the question of what does this mean? What could this mean? And it might just be that we need to just think and prepare. But Just, on values, Ellie, you'll have seen it. There's a lot of noise about a big crash, the huge crash. It's coming. And of course, this is not the first time we've seen it, even in the last few years. But, what do you think?
So apparently there's this guy, I was reading about him the other week, and I cannot remember his name now, but I won't give him any airtime anyway. But he was saying that apparently there is a crash every 17 years, and next year is the year. And I was reading into it, and there's absolutely no basis for what he's saying. Only that we had the previous crash and it must be 19 years or 18 years in 2007, 2008. But that was caused by an entirely different issue, which has got nothing to do with what's going on now. So anyway, that was garbage. But yeah, there is a lot of noise about it. And people are saying, well, it's not sustainable. Like, these values aren't sustainable. Well, do you know what? 10 years ago, we were saying exactly that. And probably 20 years ago, people were saying exactly that. But where we have had a crash previously, it has been a significant thing that has happened. It's not just come out of nowhere. The financial crisis was caused by a number of things which don't exist now. The regulation that we have in place stops all of those things from happening. And previously it was a tax issue, tax change that caused the crash, back in the early 90s. So it doesn't come out of nowhere. And I think that's a really important thing to say. It is sustainable for it to grow as long as everything catches up. And there are periods of time where you have some adjustments in property prices. And we'll all have seen that over the last 20 years or so, that you have periods where it's higher, you have periods where it's lower. And that's just normal and that's just life. But I think it's really important that we don't put too much emphasis on, this is going to happen, because you can talk yourself into these things. If everybody suddenly thought that there was going to be a crash next year, and so everyone stopped buying properties, that would in itself cause the crash.
As an investor as well, it's very easy to talk yourself out of everything, every deal, every opportunity. Yeah. And that's a very dangerous place to be. I mean, I've actually brought a little bit of data today, just some house price data. And of course, there are lots of different sources, but have you heard any natterings from lenders, from valuers about price drops, about adjustments to anything, Ellie? Is this just sort of anecdotal stuff we're hearing and seeing on Instagram and Facebook?
Absolutely anecdotal. I think with every valuation report that we have, or the bigger reports, not the sort of standard residential ones, but the bigger reports, there'll always be a SWOT analysis on there. There'll always be some market commentary. And at the moment, I'm not seeing anything. During periods of time like COVID and other periods, Brexit and things like that, there are sort of standard caveats that go into about the market uncertainty and how it could be a problem. But there's nothing in there at the moment suggesting that it could be. The thing is, it's when valuers are valuing property, they have certain criteria that they have to stick to, and they have parameters that they have to work to, that the lenders have given them direction about. And I think there's a lot of misconceptions, particularly from investors, and I see it from the other point of view. You're emotionally invested in this property, you think it's worth a lot of money. Yes, if you sold it and it was brand new and it's beautiful, you are going to get a higher than market value figure. Absolutely you are. But on a refinance valuation, that's not what the valuer is being asked to produce. They're not being asked for what's the best case scenario of if you sold this property today. That's not what they're being asked for. It's a longer term play. And it's based on sold comparable data. So you're very much reliant on what's actually sold. If there's not a huge amount that's sold, or the properties that have sold are worth less, they're very stuck, because they can't say, well, house sold down the road for 200,000. I think yours is worth 300,000. They're not allowed to do that. Yeah. So I think, valuers, don't get me wrong, they frustrate me a lot of the time. But I think sometimes they do get a bit of a bad rep, because they're only being asked to do what they're being asked to do, aren't they?
I mean, I think that's comforting, certainly to hear you, that side of the, the deal, say that, you're not seeing any material issues, you're not seeing reports coming back, that look fundamentally sort of downvalued because of sort of market conditions. I mean, a bit of the data that I looked at, and again, I think this is comforting for our listeners today. Pick and choose, where you want to get your reports from. But I mean, Halifax, August data, they reported sort of 0.3% month-on-month annual growth, 2.2% sort of average over the last 12 months. So not a million miles off flat there. Nationwide, 0.1% month-on-month, annual 2.1, very similar. Let's call it more or less flat, certainly if you factor in inflation. Rightmove, they reckon asking prices are down 1.3% month-on-month. Obviously, that doesn't quite correlate with sales data. So sometimes Rightmove and Zoopla data is a little bit ahead of the curve, but also that probably aligns with expectations that are still perhaps a little bit too high.
Absolutely. And then we had the stamp duty change, didn't we, back in April?
We did.
So I think that up until April, house prices would have been slightly higher because I think people would have been thinking, I mean, it wasn't a huge saving, was it, in reality? But I think people's assumption would be if they paid a little bit more to try and get it through for April, and then afterwards they have dropped slightly. And that's what you'll always see. The market was definitely flatter between April and June, July, you know.
I mean, Zoopla forecasts 1.5 to 2% growth over 2025.
Yeah.
I mean, that data, that is broadly flat, modest growth, if anything, and certainly not indicative of a crash. I mean, that is what that data says
stable.
if you look at that.
That's boring, really, isn't it? You know, it's
boring is good, though.
Boring is good, but we don't like boring. We have to create, you know, crazy titles in newspapers in order to get people to read articles, don't we? You know, boring doesn't sell particularly, but I think that standard growth across the economy is sitting at a very little, isn't it? So to expect a growing house price with not a growing economy, I think is probably
asking a little bit too much.
A bit too much, isn't it?
And there is one thing I want to ask you about. I heard along the grapevine that Shawbrook and some other lenders were perhaps starting to look at C3 valuations, sort of C3 to C4 valuations a little bit differently. Maybe they were doing additional checks on the values. Is there truth in this, Ellie? Do you know much about this?
Yes, there is truth in this. It is something that we've seen. It's an interesting one. I was talking to the head of risk at Shawbrook a couple of months ago, and we were talking about valuations and HMOs and investment values. And basically what he was saying was that it's almost, when you're valuing these properties, then you're lending 75% against an investment value, which can be significantly higher than the bricks and mortar. You're effectively valuing at about 100% of the bricks and mortar figure, which really means that you're investing in the business and you're lending to the business as a going concern rather than value, you know, lending to the property as such, as we've seen more traditionally with this sort of lending. So the risk, therefore, is higher. And you'll see that with the interest rates with people like Shawbrook. But it's an interesting one that they are looking at carefully because on the whole, on those sorts of properties, arrears rates are really low. And actually, we've seen across the board, the arrears rates on buy-to-let mortgages is actually lower than on residential, which is quite unusual. But it does go to show that on the whole, it's a good investment. Nothing generally goes wrong. And generally, they're happy with that situation. They're aware of it and they're happy with it. But when it does go wrong, it goes you know, it is a catastrophe because generally you've got an investor that's got quite a number of properties. They're generally in quite a condensed area because that's how property investors work. And then you've got somebody who's then trying to offload a number of properties and trying to get above bricks and mortar price for those properties, which is tricky. That's not something that's easy to do. So when it does go wrong, it is quite difficult. So it's what you need to do is kind of look at that balance. And what they're trying to work out is where we are lending on, or where Shawbrook are lending on in investment value. Have you got enough evidence sitting in the background to show that HMOs will sell for that investment figure? So there's like an established market in that location for those higher values as a bit of a backup in case it all does go wrong. If you're in somewhere where, I don't know, some village location or a small town where generally HMOs aren't a big thing, don't really sell, you're going to struggle to then sell particularly multiple properties. So they are doing what's called a C3 check, and they are looking at comparable data for the HMOs. So they're asking for sold comparable data on HMOs. And then they're also asking for a C3 check, which is if it was a bricks and mortar sale, how much would that be? That's not to say they're using that figure to lend. I have had a few recently. Doncaster is a really good example of a really big disparity between bricks and mortar and investment. And we've had a couple where the bricks and mortar figure was like 100, I think one was 150, one was 130 something. And the investment value was like 187 and 230. So it was like nearly double. You know, it's a big difference. So you're borrowing 75% of that investment value. If you then sold that for a bricks and mortar price, you're losing money on that, aren't you? You're not going to pay off your mortgage. So they will still lend off the higher figure, that 230. That's no problem. But they just want the evidence in front of them to be able to have a look at it. And they want to know that there is a market for the investment values and that could be something that's sold, which goes on to actually talking about Article 4, because I think a lot of investors are put off by Article 4. It is an additional barrier to entry, isn't it? You need to sort out planning. But I think that what we'll see moving forward is that actually there is a big benefit of being in an Article 4 area, because generally you will see those HMO sales, like there will be that track record there. The lenders can rely on that evidence. And also there's more chance of you actually selling it. If you want to sell it, you could sell it for that. If you're in some, I don't know, whatever town, local town with no HMO market, in reality, you're not going to sell it for that. I know your plans aren't to sell it generally, but if you did, you're not going to get those figures. So I think there'll be a bit more of a shift, and there needs to be probably a bit of a shift towards moving into those Article 4 areas.
I mean, I've for a long time talked about this on the show. I think that Article 4, yeah, as you said, it certainly is a barrier to entry. It pushes prices up. There's a premium. But once you're locked into that market, it's a fantastic place to be. Yeah. It's like, the analogy I would use, it's like opening an ice cream shop on the seafront, and then the council sort of saying, look, we let you do it, but we're not going to let anyone else do it. Absolutely. Or we're not going to let many other people do it. That's great to hear as a business owner. You've got that control of the supply and demand. And actually, just fundamentally speaking, talking about these sorts of problems, if the local market from a tenant perspective started to dry up or things changed, you would be grateful to be in a market where there were some restrictions, where Joe Bloggs couldn't just come along and pop up another HMO and do it. So, there is a huge amount of value in actually being within an Article 4 direction. And I appreciate that at the earlier stages of the investment careers, people starting to build their portfolios, that's difficult. They need to take a bit more risk. They need to be able to try and get more out of the deals, which means buying in at a lower value, trying to pull more out. I totally get it. But there is a point at which it really does make sense to try and have that rental confidence. And an Article 4 direction certainly does give an element of that. Let's talk about the elephant in the room at the minute, which I think has to be the economics and the politics surrounding pretty much everything at the minute. And right now, everything seems to be focused on the autumn budget. Yeah. Now, you and I have discussed this quite a bit. And I discussed this on the show recently. A number of things that I am frustrated with at the minute boil back down to a lack of pro-growth ideas. I fully appreciate that we've got some big tax bills to pay as a nation. That's clear, and there's no getting around that. There are going to be some tax changes, but it's the lack of incentives for business owners, and I think small businesses are the backbone of the British economy. And, absolutely. And house building is such a key part of some of the problems we have at the minute. And there just seems to be so little there. And of course, that is causing frustration amongst our community, amongst investors and business owners in general. That's what I'm hearing. But, I know that you've got thoughts and opinions on that. And I think some of them are absolutely, correct, Ellie, in that all this noise itself, the noise could be the problem, right?
Absolutely. And we've seen this before. We've absolutely seen it. I mean, I was working at Northern Rock when the crash happened in 2007. And knowing what I knew then in terms of how it was a reaction from, and I get the reaction. I'm not defending anything. I get the reaction. People were terrified of losing their money, but it was the reaction of consumers that caused the longer term problem. And it's the same in anything. You can talk yourself into a growth, and we say about if there's a crash next year, if everyone stopped buying property now, that would cause a crash in itself. So I think it's really important that I understand what you're saying. I totally get it. Yes, it would be lovely if we could have some carrots and thrown out to encourage people to grow, to encourage people to employ more people. I think it's really important. Growth is like hanging on by a thread, and we could so easily slip into that recession. We've got to keep spending. We've got to keep spending and earning and spending. Otherwise, it's a problem. And I think that if people are worried about there being a recession, or worried about tax rises in the budget, worried about, there's been loads of things thrown out to the press, and they did the same in the spring, didn't they? They threw all this stuff out, and then actually what came out was better than what they'd thrown out to the press. So I think maybe it was a whole media plan, so everyone thinks, well, it was not that bad, it's okay, I feel better about it because it could have been so much worse. Maybe that's their whole tactic, but I think it does worry people, and then when people are worried, they don't spend. And when you don't spend, you have a problem. Yeah,
there is definitely a press narrative at the minute. It's this extreme boom or bust, really sort of picking holes in every political decision and everything that sort of, comes out and gets leaked into the press. But the reality is on the ground, as we've already established today, things are pretty flat, pretty steady, a bit boring, if anything. Yes, we've got a low growth challenge. That is clear. But inflation is easing. The economy, yes, it's gently cooling. It's certainly not spiraling at the minute. And I think from an investor's perspective, at least, it's a slow but steady market. It's not exciting, but it doesn't look especially dangerous at the minute. I mean, that's kind of my take on everything right now.
I think so. And I think when you've got this market that's not exciting, that's where you can go in and actually get a good price on a purchase. If growth is looking relatively flat in terms of house prices, then someone's not going to be bothered particularly about trying to sell their house for a little bit less now. They won't want to hold out for another buyer necessarily, because they've got plans. They want to do whatever they're doing with the sale, and they'll be happy to negotiate. I think it becomes more of a buyer's market when you've got something like this, because we've had a few months since stamp duty's changed. Hopefully people's expectations have sort of settled on that. I think there's potential. There's always potential, isn't there?
I think it's also worth remembering that a lot of the noise about things like property crashes tend to come from a particular direction.
Absolutely.
Especially if you're, an Instagram user and you have an interest in property, and the algorithm is, it kind of understands that, somebody that a lot of our listeners, I'm sure, will be aware of, runs a big property training education company. They like to wear very stripy shirts. And I must have heard this guy talking about the great crash every couple of years for the last 10, 15 years. And honestly, I couldn't hold back from commenting on his post the other day to say, you literally said this, every couple of years. And
it's not happened.
And he came back with something. I was like, yeah, of course, there's going to be a recession at some point. The clock is right twice a day, isn't it? And that's kind of my point. But just, to our listeners, just be aware that it is often in the interests of certain people to shout very loudly about this sort of stuff, because it is quite controversial, it's concerning, it drives attention, and often there'll be something to buy at the end of whatever funnel that might be.
I think we mentioned this before we started the podcast, didn't we, in terms of how social media works now. And I was talking to somebody the other day, and she was saying that, regular posts around regular things, particularly in the mortgage world, it's not particularly interesting. When I go on, I'll chat on my social media about, I don't know, valuations or what's happening with the base rate. And that in itself, in isolation, is not particularly interesting. Whereas if anybody comes out with something quite controversial, you will immediately get people agreeing with you and disagreeing with you. And it's always the people with the more extreme views on either side of the spectrum that are the ones that shout loudest. So if you can sort of tap into that, that's where you will get more followings, you'll get more interactions. And like you say, if there's something to buy at the end of it, the more people that you bring in, the more clicks you've got through to your payment page, haven't you? So, I think you've got to really think about where someone's intention has come from. And I also think with the likes of ChatGPT, there's less people using Google. I think somebody was saying to me the other day that it's really difficult for like local news companies now, local papers, to get enough interest to read onto their website in order to get the clicks through to generate enough income. It is the whole way that people consume news is changing. So I think that we will see naturally those more extreme views sort of surface to the top because they get more views and they rise up, and that's what we see, and it's filling our algorithms, isn't it, on our social media feeds through with that. So we've really got to think about it. And I think what I do a lot is if I see a news article, I will go on and Google it and try and find an alternative view so I can see it from two different viewpoints and try and figure out what the actual truth is sitting behind it. Because saw something came through. I mean, I get an email every day from the introducer, which is like the mortgage press, and it was like it was so extreme in the way that it was talking about the potential increase in NI for mortgage, what I'm trying to say, for rental income.
Yeah.
But it was so extreme in its view. And I think, well, actually, let's sit down and let's actually think about what that actually means to Joe Bloggs. What if you're a regular investor, what does that actually mean? And I'm not saying that it's not going to impact on people, and potentially, yes, that could impact through on rental increases, but that amount of money is still relatively small in the grand scheme of things. We've had Section 24 tax increases. That is huge. That's a huge problem. This is tiny in comparison to that problem. But yet I feel like the news that we see now is so much more extreme on that example than I ever remember anybody saying about the tax changes that happened. But then that was like 10 years ago now, wasn't it, when that all started? But it's different.
You're right. The way that we engage, the place where we get our news from is very, very different now. And, it's very easy to make an awful lot of noise, and it wasn't quite the same as that, sort of 10, 20 years ago. So, Ellie, as always, but you've been a great source of wisdom and useful insight, and I think reassurance today, because I know a lot of our listeners are getting increasingly frustrated with all of the bad news and the negative press, and genuinely starting to get a little bit concerned. I have messages about whether or not, the investment landscape has fundamentally changed, whether or not it's still the right thing to do, whether or not, it's HMOs or something else. And I get those concerns, but I think it's really useful to have these sorts of conversations with yourself because, you're sitting with the lenders and
Yeah.
you're seeing what's coming
Yeah.
back.
But it's a broader thing. I mean, somebody messaged me and asked me, do you think that the change in NI will have an impact on valuations? I thought that's such an interesting thing that somebody would pick up on. And you think if you step back from that, the valuer doesn't know the profitability of your business. They don't know how you own your property. They don't know your tax position. They don't know how big your mortgage is going to be. They don't know any of those things. They don't really know what your bills are. They can make a judgment on that. But it's not for them to judge how much profit you're making on your property or how that will impact. That's not going to impact the price of the property. All they're looking at is the market value. If we sold this property on, how much would we sell it for? That's all they are concerned about. But I think it's really interesting. And I think that's probably because of the way that it's been said in the news, isn't it? It's this panic stations. Oh my God, it's the worst thing that's ever going to happen. And that then makes people panic. So if you've got people that are genuinely thinking that's going to have an impact on valuations, then of course that will make them think, do I want to buy another property? Do I want to keep the properties that I have? It triggers those questions, doesn't it? Which I don't think is, not that it's not helpful, but I think you need to be able to see the bigger picture. And when you've got these extreme headlines and clickbait, there's no bigger picture piece in there. That's not what they're interested in.
Well, I guess time will tell. I think we are agreed on the fact that there is a degree of uncertainty at the minute. We could be in for a bumpy few months. I think that probably is, likely to be the case. But I also think that we're sort of unanimously agreed on the fact that things look fairly stable at the minute. Nothing exciting, nothing too dramatic. And my advice to our listeners today would be, look, just proceed. As we have said many times on the show over the last few years, as there have been ups and downs with Liz Truss and COVID and all sorts of stuff.
Of course,
just do your numbers and don't overstretch.
Absolutely.
Manage your expectations, keep calm and carry on. And I think, at the minute, that's probably the best course of action.
Absolutely. But I think, that goes for any scenario, doesn't it? But I think probably now more than ever. But be sensible. Be sensible with your timescales. Be sensible when you're stress testing your deals. Don't go in thinking, I'll be able to do that at 5% by the time I come to refinance in 6 months' time. Probably won't be any different to where it is now, I imagine. And I have these conversations with people all the time, and I'm very, not cautious, but as you know, I don't want to say that I can do something and then not be able to deliver on it. That is my worst nightmare. So I would rather say to someone, do you know what, stress it at 6 or 6.5, and hopefully it will be less than that. But I want my clients to stress it at slightly higher than where we're at, so that we've got a bit of wiggle room in there. But I get some people that come to me and say, well, I stressed it at 5, thinking, not far off 5 on some residential rates.
No.
Never mind for your 15-bedroom HMO. So be sensible, stress it sensibly, be realistic with your timescales, because you don't want to end up spending too much money and eating away at your profits. But also, as always, negotiate on your purchase price. That is where you make your profit. So negotiate hard. Don't make emotional decisions.
Yeah. And of course, for anyone listening today who has some lending that they need either now or in the near future, make sure you chat to Ellie about it. Ellie is a specialist. She is talking to the specialist lenders. If you are investing in HMOs, then you probably need a specialist lender.
Absolutely.
And Ellie can help you figure out what's the best lender, what the best product for you and your circumstances. And we've talked about this so many times on the show, haven't we, Ellie? Everybody's circumstances and their objectives are different, and there just isn't a one size fits all. So Ellie is there to help you. Just head to the hmoroadmap.co.uk, find our services tab. There's a page for financing and mortgages, and Ellie's on there, and you can drop an inquiry with her now. Ellie, it's been an absolute pleasure as always. Thank you for coming back on the show. Thank you for a bit of reassurance, and I will look forward to having you back on the show probably just in time for the autumn budget. Maybe we can do some predictions before.
That's a good idea. Let's do that.
Thanks, Ellie.